All right, so we're zoomed in here and looking at the 5-minute chart. And again, that's the fair value gap we're going to be using here to frame it. So if you're looking at the idea of you traded down into that fair value gap, does it show willingness to go higher? Yes. Is there a short-term shift in market structure? Yes. Is there a gap? Yes. Down close candle to the left of it? Yes. Drops down in, bullish order block, optimal trade entry. In other words, that would be a 62 to 79% retracement level, less than equilibrium relative to the high and the low, respectively. So we would be looking for a limit order to be at 37.5475. We'll use that. Okay, so 1/4 point less than this candle's low. So that would be our hypothetical limit order to buy going long. And we have to use the low here for our stop loss. So 37.45.75. Essentially 9 points of risk. Okay, so we'll come back to that in a couple of minutes. But for now, what we'll be reaching for, what will be the draw on liquidity. From this high down to that low, we want to get to a premium level. 50% is about right in here, eyeballing it. We don't need to have a fib on that. You should do it for yourself. But then we have this imbalance here. So the first low-hanging fruit objective would be this candle's high. That's 37.80 1/4. So we're looking at about 25.5 handles of potential points profit per contract. So we're risking 9 points to make 25.5. Not bad. It's better than 2.5 R. So you're going to risk $1 to make $2.50 basically. And that's on a run from here to here. We don't need to know if it's going to go up to here yet. Okay. This right here is one trade from here to here. Then it creates another opportunity in here where it can run from here to here. And we'll talk about that when it gets into the discussion on risk management and trade management. All right, so risk management, kind of like walk it out for you. Assuming you had $10,000 and you're trading index futures, and you are using this trade idea that I'm outlining here, that I was monitoring in the afternoon session. $10,000 is your equity. You want to take 1% risk per trade. So you're going to take that $10,000 times it by 0.01. That's going to give you a figure of 100. That's $100. That's what 1% of $10,000 is. That means that's the total amount of risk that you're willing to assume. We determined from the hypothetical entry of your demo account at 37.54 3/4 and a stop at 37.45 3/4. That's 9 points or 9 handles. Okay, that's what that 9 is. So we're taking the dollar amount, which is the 1% of our equity, giving us $100 or 1% of $10,000. Total movement that we're willing to absorb as a risk or a stop loss is 9 points. So we take 9, divide that into 100. That gives us 11. Okay, 11 times we can get the figure 9. That 11, if we're going to trade a mini or E-mini futures contract on the S&P, the multiplier per contract is $50. So divide 50 into 11. You can't. So you right away you know you can't trade a mini if you're going to be risking 1%. So you have to drop down into the micros. So now we have 11 with the multiple of 5. So micro lot on E-mini micro, instead of $50 per point, it's $5 per point. So how many 5s can you go into 11 with it? 2. So you can do 2 micro lots. So you can do 2 micro lots at $5 per point, making profit or taking in drawdown or loss per point fluctuation. So if we're buying at 37.54 3/4 and we're risking 9 points, how much money is that? $90 risk. So we're under 1%. So we're not even risking a full 1%. Our target is 25.5 points or $255 because 2 micro at $5 at the multiplier of each point, 2 times 5 is 10. So you're making $10 per point because you're holding 2 micros. So 25.5 points here at $10 total multiplier based on the 2 micro lots, which would be basically 2.25% return. So you're going to risk 1% to make 2.25% on one intraday scalp here. And then you have another one here. And if you were trying to do shorts over here, you could have done something equivalent to that as well. So it's not hard to make 1 to 3 to 5% in one day with intraday price swings. I can frame and make 5% on one setup or first partial of a trade. So it's a matter of how you're going to form fit this for yourself. Okay. And obviously the best scenario would be if you're going to be eventually getting to the point where you can risk 2%, you can do this framework for one limit order to be buying at 37.54 3/4. Use the stop as explained here. And do a second order the same way, but don't use this as your profit objective. Use this short-term high here or the target I was outlining, 38.05 and a half. And then you would be able to get a run from here to here on one that would close out. And then the second one would hopefully run up in here and get the daily range. And you can do obviously better than 2.25%. Just on this one, you'd have 2.25 twice, because the one that you bought down, the one you bought here that got out here, that's your banked 2.25% hypothetically. Then the second one would be running here and then rolling through that level up to here. So you could be making as much as 4.5% more on the second position. So what are you really making? 6.75%. One day, 2 orders, 1 trade, freely. But stop management, okay, when you place your stop loss down here, when can you and when do I move my stop loss? Well, you have to determine where you're getting in at and where you're trying to get as a target. So that's your range from 37.54 3/4 to 37.80 1/4. So technically 25.5 points. Okay, so what is that? 12 3/4 points, something like that. We'll just round it to 12.5 points. If we see price move 12.5 points above the entry point that you entered at, if it moves 12.5 points, your stop loss can move 25% up from where? What's 25% of what range? Where your stop loss is and your entry. So split that range in terms of points. If this goes up 12.5 points, which would be 50% of your expected range, then your stop loss can be reduced or trimmed down to 25%. So it's going to give you that little bit of a cookie, that feel-good moment. You trimmed some of the risk. You're not jamming it up above the break even because you're going to worry about it. You're just moving a little bit. Now, when price moves to 75% of the expected targeted range, and it means from your entry to here, if it moves 75% of that, then the stop goes to break even. Period. There's your systematic movement of your stop loss. You're not jamming it to break even. You're not going to be worried about getting stopped out. You're going to be more likely to be watching. Does it still keep reaching for your objective? Do down close candles keep supporting price? Does it run below short-term low and then run higher with a lot of energy because it took short-term sell stops out? Is it dropping down to a fair value gap and reaccumulating and sending another higher price leg higher? That's what you're watching. That's the things that you're looking for. And as long as it's doing those things collectively or individually, you are on one side. That means you're on the right side of the market and keep holding for your position to hit target. If you are doing multiple positions, say you're doing competition level leverage, and for me, that's anywhere between a range of 3% to 4.5%, then you're going to be looking to take partials. Okay, and that partial might be, once it goes 20 points in your favor, you have a static number. It always hits 15 or 20. Once it does that, no matter what you're doing, you take something off. Okay, that's something you might want to incorporate in your own trading model as well. But that part is for you to determine. Don't let me give you static rules that are considered, cast in stone, ironclad, can't change it. I hate doing that with my students because it takes away the uniqueness, the individualism that you're bringing as the trader to your own model. So these are just basic foundational points that I think will serve you well, but you're going to obviously evolve and come up with better ways that meet your expectations and also fit your personality. Okay.